let's talk about how to use the HT watch list. So this will be the daily pre-market watch list that we prepare in the watch list channel. Again, the watch lists are our idea generation and stock research and bias. It should not be perceived as trade alerts, right? Because these are our trading plan each day. We plan for our bias, whether to go long or short. But again, nothing is 100% guaranteed in day trading, right? We can only prepare for what we think is most likely going to happen. So let's talk about it. We're going to go over what exactly is a key level, the key level and bias, long or short. We're going to talk about the upside and downside levels and all the other key information such as float, market cap, S3, etc. All these information are in chat room lingos. So we're going to focus on the levels today. So this will be a sample watch list that you see each morning in the pre-market daily watch list channel. So we'll have the ticker, the current price, right? This is usually the price pre-market. We'll have the headline ready as well because, headline is usually a really important catalyst to why we're trading the stock in the first place. We'll have the float information and the market cap, right, and a few other things. If it's like small cap penny stocks, we'll have the SEC filings, research, etc. So this is where we provide you a key level to hold. So in this case, key level is $47 to $46 area, and we'll have the upside $50. Right, we'll give you some commentary about what we see in the stock. Right, so for this one, it's a coronavirus related company, but it's very overly extended. We'll talk about if volume comes in and we hold key level, which is this 46 to 47 area, it has to hold. We can see a retest of pre-market highs of 50. We'll go over what that looks like on the chart first, right? And if we break above pre-market high, we'll continue seeing more upside on the daily. But if we do not hold key level, so if we break down $46, $47 area, we have a lot of downside back to these levels. So let's see what that looks like on the chart, right? So intraday, so pre-market on this day, remember we don't have the market data, it's trading like this. So once we identify the key level, 47 to 46 area, this is why I usually go in and draw a white line, right? You can change your colors in your thinkorswim. And the upside, remember we talked about earlier, is $50. So I'll draw a line there. Downside 44, and I think there's more downside in the watch list that says 41.5 with this area. So I draw another line. So this is the key level we identified, right? So let's talk about what key level mean exactly. A key level is, some other, similar terms that you see other people use, but it's the same idea. It's a pivot line, pivot level, a trigger level. But what that is a psychological price level that signals whether the stock is bullish or bearish short term for day trading, right? So what does that mean? If a stock breaks down key level fast with a lot of heavy volume, then we consider that bearish, right? So it's a really a trigger price that for us to gauge the sentiment of the stock. If we continue holding the key level, right? So if we are dipped down to, let's say, the $47 level we talked about, and the stock bounced off the level really strong with a lot of volume, then that's bullish. It's also known as line in the sand or over under. So at this point, so let's see what happens at the market open. This is a 5-minute chart. So if this stock, we popped a little bit to 49, if it dipped back to 47, but it bounced off, right? Instead of breaking down, if it bounced off, then that means the key level, it's holding and we're still bullish. You can see we did bounce off this level about 30 minutes before the market opens, right? So this is a significant level. If we did bounce off and start holding this level, that means we're probably going to go higher back to 50. Then in that case, the stock is most likely bullish. But what actually happened is the stock literally dumped right through the $47 level. So what does that mean, right? Over, under. So if a stock breaks down that key level, then it's now bearish. So bearish, what we talked about earlier, if it breaks down, it's most likely going to, what did we say earlier? 44, 41.5, right? That's what we outlined in the watch list. 41.5 and 50. So, okay, right? So that's why it's called a line in the sand, right? If it breaks down, then you can potentially short it back down to 44, 41.5. If it continues holding, like if it dip here, like if it at the open, if it did this action, then that means it's a potential long on the dips to retest $50, right? It's never gonna be guaranteed that you'll get 50, right? But that's the potential upside. Okay, so the reason it's called a line in the sand, it's because that's also a level to set your risk off, your stop out areas. So if you were long mRNA, that stock, and you see the stock break down this level, right? You see a lot of selling, a lot really heavy, and we just break right through. That means you should probably stop out of your position because this is a line in the sand, right? Are you really gonna hold this stock all the way to $44 from 47? No, you should not do that. Do not back hold. So this is also a trigger for you to get out if you happen to be in the stock long. And vice versa. If you were shorting the stock beneath key level, let's say if I'm shorting the stock 45 and I covered some at 44, right? Let's say I did that, but you see a retest over here, 47, then I would probably get stopped out, right? This is an area for you to potentially set your stops if you were short, right? Short, if it goes above it, then I want to cover and get out because it could potentially squeeze to 50. So if you go long, if the stock breaks down that 47, going long under that level or holding long is not ideal once the key level breaks down. Because what do we talk about? It's now bearish. You don't want to long a bearish stock, right? And the stock is most likely going to fade even further down. So you never want to back hold, okay? If you are long before the stock hit breakdown key level, that's fine. We want to take profit on the way up. But once you see it breaking down key level, do not hold and hope, okay? This is your potential stop out areas. We almost always have a bias for going long or short on the stocks in the watch list. But at the end of the day, we're not prophets, right? We don't have crystal balls. We're not guaranteed to be right 100% all the time. The key level breakdown or hold is a price action. That's the key indicator for us to go long or short. You can plan all you want, right? We plan out all our trades. You can plan all you want, but if you're wrong, right, which is our bias, but if you are wrong, you have to be ready to stop out, and sometimes you can flip your bias long or short. So for example, if I was long in the stock at 47 thinking that it's gonna bounce off and I see it didn't and we broke down so quickly, then potentially I might want to flip short. And remember, once I flip short, the risk is still the same $47 area. But just remember, this is our short-term bearish or bullish signal, and you don't want to be on the other side once it breaks down. Okay, now let's talk about the upside and downside levels. So, remember we talked about, this is the key area, but there's upside to 50, downside 44, 41.5, and so on. These levels, they act as profit-taking targets. If you're short, you want to cover into lower levels of support lines. And if I was long, I want to sell into upper level resistance. So if I was long the stock at 48 because I saw that 47 held, then potentially I want to sell towards $50. You can see on this bounce before market opens, we didn't get that 50, right? You're not guaranteed to get that 50. That's why you want to learn to take profit on the way up. But you could have gotten 50. And if I went short after it broke down, I want to make sure I cover some at 44. It could go all the way to 41, but I don't know, right? It could, but it doesn't have to, right? Just because you want it to go down to 41 doesn't mean it will. So that's where you want to potentially take your profit. If I was so short, I would get stopped out here. But ideally, you move your stops down. Okay, so these lines, the red lines, the upside and downside levels are potential profit taking. Potential only, right? You're never gonna be guaranteed to hit those levels. It would be nice if we hit 41, but we hit 44. I took some. I was hoping it would go down to 41, but we didn't. So you're never gonna be guaranteed to be right all the time. You take what the market gives you. Okay. Also, these upside and downside levels are potential areas of reversal. So if a stock holds and consolidates at lower level support, then that's potentially a long entry for an upside. Same way, if a stock tops out and rejects a higher level resistance, then that's another potential entry to go short. So let me talk about what that looks like. Okay. So you can see, let's say I was short and I covered some, right? So this level, potentially it's a level for loans to go in and buy for a reversal, right? You're not guaranteed a reversal, but it's pretty, you could potentially get some bounce at these lower levels of support, right? We're not guaranteed to go all the way back up, but if we bounce at 44, right, you can see the stock holding. You're on 5-minute charts, give it some time. Once you see, it's actually holding 44, potentially you can go long around 44.30s, right? And you can test the potential upside back to key level. In this case, we did hit key level, but you're not guaranteed to. And we actually went a lot more, right? So you can play, this is how you play within the levels. If you miss the short, you can potentially wait for the long here, right? For a bounce, maybe just 50 cents, $1, you're never guaranteed $3. And vice versa. If I miss the long here pre-market to 50, if I missed it, and you see the stock starting to top out around 50, then potentially that's an area for you to go short, right? If you're short at 50, you can maybe see 48, 47, maybe even lower. So basically, these red lines, the upside and downside targets, are potential areas of reversal, right? A stock is not just going to tank all the way from 50 down to 37 without a bounce. So that's how you play and use all the different levels in the watch list. If you want to go, whether you're long or short bias, if you're patient and wait for your entry, there's almost always a play for you. That's why, these are potential points of reversal, right? There's all other video lessons on what a hold and a reject of level looks like. So you want to check those out. But basically, if you want to look at it, these are areas of potential entries, long or short. These are not alerts, okay? Like, I don't know how you can view this as an alert to go long. You want to wait for the price to go to this area. And if it matches the price action that you're looking for to go long, then you go long. If it stays heavy, then probably there's another short back down to 41. Okay? I just want to stress this. These are not alerts, trade alerts, right? These are not trade alerts. We are prepared with a bias, but at the end of the day, we're not prophets when we don't have crystal balls, right? We plan for the best, which is the bias, but we're ready to stop out and flip up bias potentially if you're wrong. But most of the time, the bias in the watch list is very, very useful. And if you just wait for these potential entries and you watch and observe with patience without just jumping into any stock when chasing weakness or chasing breakouts, the watches provide you a lot of value, whether you like to go long or short. Okay, if you're unsure about how I came out about these key levels, there's tons of videos in the video library on drawing levels and how, the order I draw my levels and how to play within the levels. It's there's a webinar called exits, entries, stop losses, and everything in between. So feel free to check that out. Thank you guys, and reach out if you have any questions.